For many, Bitcoin seemed like just some funny internet money, but that all changed on January 11th, 2024, when the largest asset manager in the world, BlackRock, launched their Bitcoin ETF, along with Fidelity and 8 other firms. The ETF approval by the SEC made it easier for the average person to invest in Bitcoin and likely added to the trust in the overall asset. In this video, I'm going to break down the case for why Bitcoin should be included in your retirement portfolio, the case for why you should want to maybe avoid it, and then the pros and cons for buying Bitcoin in your IRA or controlling the digital assets yourself. The case for Bitcoin. Some make the argument that in just 14 years, Bitcoin will be the most valuable asset in existence ahead of gold. Today, Bitcoin is more valuable than Tesla, Visa, Berkshire Hathaway, which is Warren Buffett's company, and Walmart. The total market cap or market capitalization of Bitcoin is $1.2 trillion as of April 18th, 2024, as compared to gold's market cap of $16 trillion. If Bitcoin's market cap reaches the same as gold, it would mean each Bitcoin would be worth approximately $760,000. Gold is an effective store of value for more than 2,000 years, but it's heavy, it's expensive to store, it's expensive to transport. It's hard to send to somebody else if you wanted to. You can't just throw a gold bar in the mail. And it can be confiscated and stolen. And most importantly, there's still more gold in the ground. And there's even talk about mining gold on the moon and Mars, which means the overall quantity is still unknown. We're pretty sure there's only one Mona Lisa, so its value is incredibly high, if not priceless. When it comes to Bitcoin, though, the maximum supply that will be ever minted is 21 million. But in reality, the total number available of Bitcoin in the world will be far less. It's going to be closer to 14 million. Before I get into why it's likely only 14 million Bitcoin in the world, let's talk about this halving event that's happening later today, April 19th or 20th, 2024. I'm not going to get into the details of the Bitcoin halving itself. I'm here for more of the explain it to me as if I'm a 5-year-old version. To be fair though, most 5-year-olds likely understand Bitcoin better than most 55-year-olds. But here we go. In order to counteract inflationary pressures like the US dollar is experiencing today as we print more money, Bitcoin was designed to be deflationary. It does this by producing less and less Bitcoin each year until it reaches that maximum 21 million that was designed for. Bitcoin is produced through a concept called proof of work. You've likely seen all these Bitcoin mining operations on the news that show the massive buildings out in Texas that are setting up these big data warehouses. Mining at scale involves data centers packed with highly specialized computers that crunch math equations in order to validate these transactions and simultaneously create the new Bitcoin tokens. It requires expensive equipment, some technical know-how, and a lot of electricity. Basically, they're in the business of producing Bitcoin, and they get rewarded with Bitcoin when their computers solve all these complex problems and calculations. The amount of Bitcoin miners get rewarded for gets cut in half every 4 years, hence the name Bitcoin halving. This year, the reward will go from 6.25 Bitcoin per block mined to 3.125. At the current price of Bitcoin, that would be nearly $200,000 per mined block. This puts a big pressure on the miners to stay efficient, or they'll go out of business if they don't have the right procedures in place to produce the Bitcoin at a low enough cost that they're getting rewarded for in the network. So remember when I said there was only going to be 21 million ever produced? Then I said there's only going to be 14 million or so available. Well, over the past decade or so, people have lost their Bitcoin wallets, they've forgotten passwords, things have gotten stolen and maybe never recovered, and other silly things. That Bitcoin is lost and never going to be coming back. This truly limited supply makes Bitcoin the hardest, rarest form of money in human history, and the only form of money that wasn't created by and isn't controlled by a central government or bank. How could Bitcoin eventually hit $760,000 in the next 15 years? Because governments around the world, like the US, are bankrupt, and their only two options to deal with that problem is 1, default on their debt and become a third world country, or 2, print more money out of thin air to pay their bills. Given the choice, every government will choose to print more money. This will continue to flood the world with worthless fiat currencies, causing more and more inflation in the process. People around the world were already waking up to this fact that goods and fuel prices are up 200 to 400% just in the last 4 years alone. This inflation and money printing incentivizes people to trade in their dollars for Bitcoin in order to protect their wealth. It's just like a person in Venezuela, Egypt, or Argentina exchanging their native currencies for US dollars the instant that they get paid. Money flows to where it appreciates the most. And now we have people all over the world exchanging their native fiat currencies for Bitcoin. This is creating a self-fulfilling cycle that could take the price of Bitcoin up to $1 million or more by 2030 if the current rate of adoption continues. The biggest names on Wall Street like Jamie Dimon and Larry Fink used to call Bitcoin a scam and worthless, but they've changed their mind. On January 11th, 10 new Bitcoin spot ETFs were launched to the public markets. So far, the Bitcoin ETF has been the most successful ETF launch in the history of the public stock exchange. BlackRock, the most powerful investment firm in the world with over $10 trillion in assets under management, is run by Larry Fink. Yes, the same guy who changed his mind about Bitcoin. Now he calls it the ultimate flight to safety and digital gold. And today they run the most valuable Bitcoin ETF in the world, the IBIT. So why should you include Bitcoin in your portfolio? It's the scarcest monetary asset ever created in the history of man. It's the first and only form of money ever created in the history that isn't controlled by a man or a government, and it can't be changed or abused. It's the most secure form of money ever created. It's the most accessible form of money ever created, and it's the most efficient form of money ever created. Bitcoin is digital property. When you buy Bitcoin, you're literally buying real estate on the future's most important and most valuable financial network. So why should you avoid Bitcoin? It goes without saying that Bitcoin and cryptocurrencies are very volatile. And if you can't tolerate large drops in value, it may not be something that you want to invest in. There's always a possibility that Bitcoin and other cryptocurrencies could be worthless. There are ways to own Bitcoin and control it yourself, which can be intimidating for some. While you can invest in various Bitcoin ETFs to avoid the responsibility of controlling your own Bitcoin, it does mean that you don't own the Bitcoin, you own the shares of that ETF. There continue to be regulatory risks in the cryptocurrency space, which could cause more volatility and limit access. Government regulations around crypto are constantly changing and evolving and could be different based on where you live. Regulations could impact how you use or access your crypto, which could cause more volatility and uncertainty. But since crypto is so new, it may take time for policymakers to establish more clear, consistent guidelines. You should always consider talking with a professional investment advisor to help you make the decisions based off of your risk tolerance. Now let's talk about how you can acquire Bitcoin for your retirement. There are two main options. One is to purchase the Bitcoin ETFs that were just launched, or two, purchase Bitcoin using a crypto exchange like Coinbase and use private storage. Thanks to these new ETFs, you can use the money in your retirement accounts, your 401k, your IRAs, to buy Bitcoin directly on your preferred brokerage, like Schwab or Fidelity. At a minimum, I'd consider maxing out your Roth IRAs with these Bitcoin shares so that every year you can enjoy gains 100% tax-free at retirement. There are two main ways to store your crypto, either privately with a non-custodial wallet on a personal device like an app on your phone or a cold storage wallet, that's what I use, or using a third-party custodian like Fidelity or Coinbase, which will be used if you're going to be purchasing through one of the ETFs. If you prefer the easiest option with less control, buying the Bitcoin ETFs is a great path. If you prefer having more control over your Bitcoin, then you should probably consider storing it privately and not inside of the IRA or brokerage accounts. When storing them privately, you're solely responsible for the safety and security of your crypto. If you lose your private keys, your hard drive might crash, or a virus corrupts your wallet, you might lose your funds entirely. Cold storage offers the most control over your assets, but also has the most responsibility associated with it. I store my crypto on a cold storage device like the Trezor or Ledger, but it does force you to learn how this technology works. I'd recommend starting with a smaller amount of money in crypto on a cold storage device just to familiarize yourself with how that device works before you commit to using larger amounts in the future. If you do decide to purchase a cold storage device, be sure when you're buying the Trezor or Ledgers to buy only from that device manufacturer's website. There's a lot of scams that are going on, and if you buy from other sites like eBay or Amazon's or other sellers, there's a possibility for potential bad actors to get in there, installing malicious software, or even stealing the keys that they can steal your crypto later on. The saying goes, not your keys, not your crypto. Basically, if you don't control the encryption keys to your Bitcoin, then you don't control the asset itself. This doesn't mean it's not safe to invest in the Bitcoin ETFs, but understand that you're relying on the third-party custodian, the Coinbase or the Fidelity, to maintain your Bitcoin. While Bitcoin and cryptocurrency can be confusing and intimidating, it's the future. So starting to understand it and participate in it will only help us later on. Thank you for stopping by, watching the video. Make sure you hit like and subscribe if you enjoyed the content. And I hope something great happens to you today.